Stocks stay ranged as the crucial meeting of the GST Council on rate rationalization kicks off. Metals and healthcare eke out some gains, but IT and telecom drag.
Indus Towers is set to piggyback on Airtel to foray into Africa, starting with Nigeria, Uganda and Zambia. The move to scale and diversify its business, while positive, will hit dividend payouts, which is a key concern for investors. The stock is lower.
Eternal's food delivery arm, Zomato, has upped platform fee for orders by ₹2 to ₹12 ahead of the festive season. Analysts see the move as modestly positive, as some of it may trickle to the delivery partners. The key concern remains competition from Rapido.
Professional services at-home platform Urban Company announces its 1,900 crore IPO, including an offer for sale of over 1,400 crores. Both, best known for its headphones and smartwatches, also get SEBI's nod to go public.
Two big policy issues grab the spotlight today. While the critical meeting of the GST Council kicks off to decide on rate rationalization, with states firm on revenue protection, Commerce Minister Piyush Goyal holds out hope of clinching a trade deal with the US by November.
Hello and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Mangala Malu as well as Ekta Batra. Hi guys, good afternoon. But today what we're seeing in terms of the benchmark indices, a bit of a volatile and range-bound trading session. But broader end of the markets are outperforming like yesterday.
Yep, it's a good market. I'd say that because, despite the consolidation that we're seeing in the frontline end of things, two internals look a lot better than what they were over the last few trading sessions. One, the advanced decline. That's doing extremely well. We have nearly 2,000 stocks which are in the green for about 800 stocks which are in the red, marking the third straight day of more advances than decliners on the straight. The second part is that the Nifty Bank, which was underperforming for the last 10 or 12 trading sessions, is now outperforming. Not by a much, but it is still an outperformer. So that's a positive. And the third thing, as we're looking at the India VIX, which is down 3%, even as the frontline indices are consolidating. We have two big events, the GST Council meet, and any sort of, clarity that comes by on tariffs would be triggers for the market. So let's see how that goes. So biding time, but not bad.
Oh, well, yes, biding time for sure. And not blowing our trumpet. But nonetheless, it is turning out to be a day of consolidation. And we have the GST meet, which is, today and tomorrow. So that is going to be just about waiting and watching. But we do have a lot of stocks in focus. And that seems to be the key theme playing out in today's trading session. And a lot in terms of what's moving companies include acquisitions. So TBO Tech is in focus on the account of an acquisition. NetWeb has, a significant order win of around 1,734 crores. MOIL, their manganese ore production for the month of August was up around 11%. So that was also a positive. And JSW Cement is reacting to its first quarter post a listed company. So that stock is up around 1.6% and good amount of volumes traded on that one as well. But that's all that's taking place in terms of specific stocks. So it is a lot of stock-specific action in today's trade. Let's kick off the show, in fact, with some opinion from the 21st Motilal Oswal Annual Global Investor Conference. Our colleague Nimesh Shah did catch up with Nitin Jain, who's the CEO and Principal Fund Manager at Kotak Mahindra Asset Management. He manages over $5 billion in terms of funds. He shared his outlook on the Indian market post the recent correction and how to tackle the tariff uncertainty. Listen in.
The mood about Indian markets, honestly, and thanks Naresh for having me, is a little bit, not the best of the moods at this point of time. That said, there are a lot of things which are working behind the channels. Of course, currently speaking, the tariff, the US tariff, is overwhelming everyone's opinion about India. Maybe this is a good time to reassess India. The pessimism seems to be at real peak as we speak.
Sure. So, are you looking to deploy more funds into India? How are you positioned in India right now? Are you sitting on cash? Are you fully deployed?
So, as a philosophy, we are a single country India fund.
Okay.
We don't tend to use cash as an instrument. Okay. So what we do is always for long-term investing. So we don't change our portfolios too much in that sense. So in some ways, we are invested in India, and the current valuation and the pessimism that we see, there is no reason for us to
held back or hold back.
Sure. So, but we will have some cash here and there, but it's not out of sync with our long-term trends.
Okay. Nitin, the very near-term trigger is going to be the GST rate rationalizations. That's something which everybody's been talking about. As a fund manager, have you looked at realigning your portfolio to some extent towards consumers? Because that's been the big talking point that maybe it's time to shift from capex to consumption.
If you look at that theme, last few years it has been more about capex, infrastructure. But we have been very, very clear in a long-term view that in India, consumption plays a very important role. As incomes rise, consumer discretionary consumption will take a big benefit out of the income rise. So if you look at our portfolios, say 6 months back, we were overweight consumers, especially consumer discretionary. Now the new environment makes that view even positive. So we have seen tax cuts, we have seen monetary policy rate cuts. We're now talking about GST rationalization. We are running into festive season. We have seen low inflation. We are talking about rural income recovery. So consumption, broadly speaking, remains a core of our portfolio. Now, all of these steps are going to be taken positive from our perspective, just reinforces our view that consumption should be a core of your portfolio at all points of time.
Sure. Just to play devil's advocate on consumption, Nitin, there is an argument that the valuations are still not very cheap for the consumption stocks. Everybody's sitting at 40, 50, 60 times. But you sitting out of Singapore, looking at all the other markets as well. In that context, do you think Indian valuations of Indian consumer names are decent enough?
So,
how will you look at consumption as a basket?
So consumption is not at the same valuation that the market is. When you think about India premium to emerging markets, it's come down from a very significant premium towards long-term averages, which is still a steep premium to other emerging markets. And there are many reasons which have been documented over a long period of time why India enjoys a premium. In our view, nothing dramatically changes in that. The reason for India premium stays, and the premium has now come down to long-term averages. Now, within a micro sector of consumers, India consumer story is very, very, very promising. Ultimately, it's 1.4 billion people who have a combined story of penetration, premiumization, and consumer discretionary on top of it. So I think the story on long-term basis is very, very intact as we speak. Now, valuation, one may look at growth. So consumer staples may look expensive, consumer discretionary may look expensive, but our view in consumer discretionary is consumer discretionary has much higher level of growth and profitability levers, than what the other segments of consumption may have. So we are looking at businesses where there is obviously growth and there is profitability to follow.
Apart from consumption, how are you positioned in the Indian markets in terms of IT, in terms of say metals or any sector which looks very attractive to you at this point in time?
So traditionally, we are not a very large commodity investors. So we tend to stay away from energy commodity in our portfolios. So we are in IT in specific a little bit cautious, given how things are panning out. I think at this point of time, the valuations are looking reasonable. We do worry at some level that the US-India tariff situation does not extend to services. Hopefully, it never does. So that's a risk that is there, but that's something that we really don't overtly worry about it. But it's back of our mind. But net to net, we are positioned well in consumption. We are positioned well in financials. We are positioned well in healthcare. We look at services in a positive view, and we have others like we have toned down or dialed down some exposure to industrials in favor of consumption. That happened over the last 12 months. But broadly speaking, that's where we are well positioned in our portfolio.
Nitin, I know you're known as a champion for mid-cap picking. You're broadly into the mid-caps and small-cap universe. What's your take there? Broadly, from a valuation point of view or from stock picking point of view, are you finding enough opportunities in the broader market stocks?
So first, let me correct, we are in mid-market. Yeah. So we do run all cap and we have mid-market. So we have a large mid-market practice at our end. Yeah. So our focus is not on the smaller mid-caps, we focus on the larger mid-caps, which are category leaders, good strong balance sheet, good management. So we stick to that. Interestingly, our mid-market universe over the last 5-6 years has widened quite a bit. Yeah. So we have more and more opportunities. Yes. Of course, we know that liquidity has also improved quite dramatically. So the risk associated with mid-caps, traditional risk of illiquidity or diversification is no longer a problem. In the last 4 or 5 years, the balance sheets of mid-market companies have also improved quite materially. So we are not finding any big need or trouble on the other side of finding good businesses. Now our businesses are growing at a clip which is faster than economy. We know that economy is going through a little bit of volatility at this point of time, but as long as the underlying businesses that we own are doing what they are expected to do, we are not too overtly worried. But we keep a very close eye on the macro developments. And in that sense, obviously, the US tariff situation is something that one keeps a close view on.
Okay, interesting chat there with Nitin Jain. But let's talk about some of the stocks that are moving in today's trading session as well. Vamakshi is joining with us for those details. Good afternoon, Vamakshi.
Well, good afternoon, Vinny. Let me first take a look at TBO Tech. The company's unit will be acquiring US-based classic vacations for around $125 million. So that's the news flow, which is why the stock is surging up high by almost 13%. And this is the third consecutive day where the stock has advanced. In fact, the gain today is the biggest intraday advance that we've seen since the company's IPO. And this up move is coming on the back of extremely strong volumes as well. 24 lakh shares traded so far, which is almost 20 times higher as compared to the 20-day average. The next stock in focus is Piramal Pharma. The stock is seeing the biggest intraday advance since the month of March. The stock, however, has not done very well. So this is one of those beaten down names which is finally coming to life this time around. So far it's down almost 22% year to date. In fact, it cooled off almost 35% from the 52-week high. And this up move today of almost 7% is coming on the back of very strong volumes. 1.25 crore shares traded so far. NMDC Steel is the next counter we're watching out for. It's up for the fourth consecutive day. The stock has managed to see a good recovery from March, April onwards. It has managed to recover almost 33% from the 52-week low. And the volumes today are very strong. They're almost double as compared to what we saw yesterday. And lastly, take a look at Jain Irrigation. This counter too is doing extremely well in trade today, up almost 7%. Jain Irrigation, the stock is advancing for the fifth straight session. In fact, in the last 5 days, the stock is up almost 21% and the volumes are almost twice the 20-day average we've seen so far. So Jain Irrigation too having a good day in trade today.
Okay, all right, Vinny. Thanks very much for that. So those are all of the buzzing stocks at this point in time. Vamakshi. But we'll take a short break on that note. We'll get you more on the markets and lots of stocks on the other side. Stay tuned. Welcome back. Well, for the markets, it's just about consolidating at this point. The Midcap index is where the action's at. So the Midcap index is up around 0.3%. There's a little bit of a pickup which has taken place for the Nifty as well, but it's just, up around 50 odd points on an absolute basis. So while there has been a little bit of an incremental shift which has taken place, on an absolute level is just about higher by around 50 odd points. And for the Sensex as well, just about higher by around 130 odd points. The important parameter is the advanced decline ratio, which continues to be on positive terrain. But let's now shift focus to our fundraise segment. And it's an interesting segment that we have where we're discussing the PE and VC investments that we've seen this year as well as in August. India's private capital markets have witnessed a shifting landscape. And the PE VC investments, in fact, have declined 55% in the month of August, according to reports. And on a year-to-date basis as well, it's down around 16.5%. We have with us Vivek Singla, who is the managing partner and CIO private equity at Incred Alternative Investments, to discuss this. Vivek, hi, welcome to the show. Well, what is taking place considering that PE and VC investments have fallen 55% in the month of August on a year-on-year basis, and as well as around 16.5% to 17% this year? Is there trepidation, some amount of cautiousness which is now coming about?
Right. First of all, happy to be here. Thank you. I think you're right. We've been seeing, volumes and value on the, on the deal making front have been soft for some time. Okay. We used to be around $60-70 billion a trade in a year in the last, I think, year or so by 21-22. And that slipped to about $40-50 billion in 23-24. And even this year, I think we are seeing a slippage in the deal value. In my mind, I think there are two large reasons for this. One, I think, coming back from the highs of 21-22, when there was huge amount of focus on growth, I think profitability was sort of pushed back in the corner. and excessive amount of investment happened during that time. But I think as the time has passed, more and more firms have realized that ultimately the underlying businesses have to perform, and which is why profitability has taken center stage, right? And I think the firms are now waiting and watching for profitability to kick in before writing the checks. So that's number one. Number two, I think if you see what is happening in the public markets for the last 12 months, I think we are finding that there's a bit of sluggishness in the environment. And I think some of the big unlisted companies which had a huge fan following in the unlisted domain, they did not perform up to expectations post IPO. So that also is weighing on the minds of the PE firms before going in. I think they're keeping a bit of margin or buffer before going in, and I think both these parameters, the pricing as well as profitability, are the factors which are driving that elongated deal making or the process of deal making, which is why you will find the closures have been a little soft.
That's interesting, 59% decline because of the reasons that you're talking about. One, looking at profitability. The second is maybe exits haven't been as lucrative. But at the same time, if you could give us a sense on, whether there is dry powder with the PEs. What is their investable capital versus what is invested? How does that ratio stack up over the last few years? I mean, we just want to understand because a lot of the family offices, a lot of the HNIs, all of them are looking at private equity as against public equity for as an attractive option right now, or getting much earlier in the line. So from the investable capital that there is versus what is invested, how has that ratio panned out?
I think the fundraising has been still quite robust, if you ask me, the last couple of years. Okay, we find both on the international front as well as even in terms of the domestic flows, the AIF fundraising, etc. There have been a lot of investors who have started, exposing themselves towards the private markets, and rightly so, because this is that market which is likely to deliver that alpha. And I think the dry powder with the firms, definitely over the last 3 or 4 years, I think we are finding billion-dollar funds have been raised in the market. Investable surplus is definitely high. And at the same time, I think India being such a large opportunity set, the considerations that when it comes to investments are also, I think that set is also fairly large. So I do find that maybe in the near term, you'll find there's a bit of mismatch on the dry powder versus, the potential opportunity. But I think that correction is likely to take place over the next 12 to 15 months. So whatever dry powder is there in the market, I think there are ample opportunities in the market which will take care of this dry powder.
Okay, there are ample of opportunities which will take care of this dry powder that's there right now. Vivek, in terms of overall, are we seeing any sort of small deals happening, or even small deals are off the table right now? And what is the sort of delay that is going on currently?
No, deal flow, especially on the small market size, is definitely quite active. Okay. And I find that more and more firms, especially on the early stage ecosystem, they are trying to incorporate elements of AI, right? That is one hot space where, whether it's from the company standpoint or the firm standpoint, those conversations are very active. Okay, so even traditional sector or even the tech sector, wherever I think the conversations around AI, I think that space is very active. Maybe on the large cap side, the large deal making side, there may be a bit of slowdown, but I think that's again a temporary phenomenon in my mind. And ultimately, I find that the last 2 or 3 years have been very healthy in terms of the correction, both in valuations as well as move towards profitability. So from our standpoint, I think things are looking very healthy here, if you ask me on the deal.
Just Vivek, wanted to understand how much have IRRs come down on an average, say if you had to compare it to the 2021 or 2022 period and now?
IRR, I think, is a very, the number is too diverse, and, the range is very wide for me to be able to come to you with a particular number.
I'm just asking, in terms of the PE exits and the returns, how much of a recalibration has there been in the past 3 years?
I think the top quartile funds maybe 3-4 years ago would be operating in the range of 25 to 30%. That number today may be in the range of about 20%.
Sure.
If you ask me.
And are you expecting this cycle to change? What are you, since we have seen these kind of statistics for the month of August and year to date, are you expecting a move towards, say, a higher return, increase in PE investments?
Oh, definitely, yes. Like I mentioned, right, this is just a cyclical phase in any industry, right? So our industry is same. What happened in the 21-22 time is just, I think there was excess amount of capital which went in. And that time, I think people maybe at some level lost focus of the valuations or, maybe a little over bullish. But I think the conversations which have happened over the last 12 months, 18 months that we are seeing, I think there's a lot more focus on valuation. There's a lot more focus on profitability. And this is ultimately going to play out in the returns that you'll see coming out in 27, 28. So we are likely to go forward, see that 25-30% IRR coming through, for sure.
Okay. Vivek, just a quick one. You said AI, yes, there is opportunity, but X of AI, where are you seeing opportunity? And also valuations of Indian startups versus rest of the world. How are we standing currently?
So besides AI, I think 2 or 3 themes look very promising. Okay. Number one, I think consumption is that one space which really has not performed, if you ask me. This is the largest space in our GDP. But I think for whatever reason, maybe it's, taxes, maybe it's low disposable incomes, etc. And I think government does recognize that, right? So if you see the tax rebates, if you see the GST rationalization, etc., I think they are going to give money back to the consumer. So this is that one sector that is poised to grow. The other is financial services sector. I think the last 2 or 3 years, there was, I think, credit offtake has been slow or the delinquencies were on the high. But I think this is one sector where valuations have been very amenable. And this is the other sector that is likely to grow hand in hand with consumption. And the third sector, especially, is the niche manufacturing or the new age manufacturing, which is the national priority areas like defense and aerospace. So besides AI, I think these 3 spaces definitely will perform.
Take that point, Vivek. Thank you so much for that. So after the highs, we are now pausing for breath, and maybe once there is enough rest that everyone's taken, both the investors and the opportunities, there would be a match over the next 12 to 15 months. We will obviously keep checking in with you periodically to know where that ball is moving. As of now, it's artificial intelligence, consumption, and some of the niche manufacturing areas where he sees some traction. With that, we'll take a short break, come back, get you more on the markets, the listed markets, that is, because the Nifty is consistently zooming ahead right now. 24,650 is where we are, a 60-point bump up led by the Nifty Bank. At the high point, get you more on markets after this break.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty has moved up a few points, right, from the day's lowest point. Also, we're seeing a recovery coming in, holding on to gains of almost 0.2%, 50-60 points up, day's highest point. But what are we watching out for now in the world of F&O? Mangalam is joining in with us for that. Mangalam.
Well, moments ago, the market was consolidating, flitting between red and green for the Nifty as well as the Sensex. But we had pointed out that the possibility of it moving higher is high. And that's exactly what's taken place. Right now, the Nifty is at the high point of trade. And the reason for that is pretty simple. The Nifty Bank, which was underperforming, has now become the top contributor. So the Nifty Bank is doing extremely well. And for the third straight session, we have the Midcaps, which are outperforming. So the Midcap index doing well. We have nearly 2,000 stocks which are advancing versus the number of stocks which are declining. But more importantly, even as the market was consolidating, volatility index was cooling off, telling you that there has been put writing activity which has taken place, and the street believes that maybe the market has been forming a base, especially after the sharp bout of decline that we saw in the last hour of trade yesterday. Metals, they're picking pace as well. Now, the street believes that there could be some relief coming in from the Fed when it comes to rate cuts. Sometime during this month, we have the Fed meeting. So every time there is a US rate cut, we have a concomitant positive impact that we see in terms of the prices of commodities. And that's what we've seen in that's what the expectations are building up for some of these ferrous names as well. Now, as the Nifty is moved higher, let's look at a couple of important levels we need to cross and close above on the Nifty. It'll be the 20-day moving average and the 100-day moving average. Both these levels, the Nifty crossed yesterday but failed to close above. So today, that will be extremely crucial. And the Nifty Bank has taken support at the 200-day moving average itself. The levels that are important on the Nifty, 24,600 call writers, fairly active in today's trading session. The premium that they have is 155, telling you around 24,750, we may see some sort of resistance. 24,600 put writers equally active, telling you that around 24,550 to 24,450, we will see strong support. So between 24,450 to 24,550 is the support. 24,750 is where the next leg of resistance comes in if we go ahead and cross and conquer the 20 and the 100-day moving averages. A couple of stocks on our radar. Piramal Pharma has been doing very well since morning and fairly well bid from an open interest standpoint as well. So a lot of long positions added on that counter. And RBL Bank may enter F&O ban today. Remember, over the last few trading sessions, we've been seeing OI build up on that stock. Now it's very close. In fact, has crossed the threshold of that 95% of market-wide position limits as well. When it does cross that and close above that, the stock goes into F&O ban. So the first stock of the September series to be in F&O ban would perhaps be RBL Bank.
Okay, all right, Mangalam. Thanks very much for that. Just look at a couple of these stocks move. E2E Networks is now locked in Abbas circuit after bagging a deal worth around 177 crores. Separately, we have NetWeb also, which is now up around close to 10% at this point in time. So the market seems to be really rewarding companies which are forging ahead when it comes to, say, revenues or in terms of order wins. So that seems to be the theme which is really playing out at this point in time. Moil also at the high point of the day, up around 5% for that particular counter. We'll take a short break on that note, but we'll connect with the management of Open Company as they receive the SEBI nod for their IPO. Stay tuned.
Well, we were talking about some of the ferrous names doing well. Now look at the non-ferrous names as well. Hindalco's moved to the high point of trade. We're seeing some traction in ITC as well. And just watch out for Interglobe Aviation from the broader markets. That's the one that is taken off currently at the high point of trade for Interglobe Aviation as well. So those are a bunch of stocks which are doing well in a market which has now picked some pace, currently closer to the 24,650 mark for the Nifty. But let's talk about the primary market action. Urban Company, something that is fairly popular with consumers, will now move into the investment bracket as well, because it's received its SEBI nod for the IPO. The 1,900 crore issue is priced at between 98 rupees to 103 rupees, set to open on September 10th. Rima spoke with the management, and this is what they had to say about the growth plans going forward.
If I talk about the last 3 years, we have scaled our net revenue from 437 crores in FY22 to about 1,144.5 crores in FY25. And in this period, for the 707 odd crores of incremental revenue that we've added to the top line, about 385 crores has gone to our adjusted EBITDA, which shows the strong contribution margin and gross margin profile in the business. We track at a contribution margin of about 56% of net revenue, or roughly 19.5% of net transaction value. We've also kept our fixed costs fairly steady in the last few years. Profitability is an important goal for any company, and for us as well. As we continue to scale, we would want to continue to focus on operating leverage, cost excellence, and continue to scale with profitability.
So suppose your top line doubles from here on, right? It's about 1,100, 1,200 crore rupees in terms of net operating revenue. It doubles. Adjusted margins in Q1 were 5-6%. What could that number look like?
It would be hard to sort of put a
Double
specific...
digit?
Let me put it slightly differently. I think the areas where we would want to invest would continue to be technology, would continue to be training and service professional excellence and quality, and brand building. I think we would like to make these investments, albeit at a slower pace than revenue growth. So any growth in revenue that we see, especially in our core business in India, which is already fairly profitable, it was operating at a close to 10% adjusted EBITDA in FY25. I think any investments we make there, we would want to be very mindful that those investments are not growing faster than top line, so that we can continue to see sustained margin expansions every year. I would avoid giving any forward guidance, but we're committed to improving the quality of the business with every passing year. One of the things that is our internal principle is that every cost line item every year should see operating leverage. And that's a philosophy with which we operate internally.
Okay. Just for the benefit of our viewers, you have three sources of income. One is India consumer. That's your core market, profit center, 10% EBITDA margin, 75% of your top line. Second is your native brand, where you are manufacturing hardware products like lockers, like security locks, air purifiers. And third is your international business. That's about 10%. Now, native and international is loss-making as of now. We'll come to it. But let's talk about your India consumer.
Sure.
Talk to us about your ambition here, the strategy, the opportunity that you see.
So, Rima, India Consumer Services is our largest business. As you rightly said, it's about 77% of our net revenue in FY25. It's one where we offer a host of services at home, be it beauty services, cleaning, carpentry, plumbing, AC and appliance repair, painting, etc. We still think we are only getting started in this business. The opportunity is humongous. The total addressable market for home services in India stood at nearly $59 billion last year. And it's expected to grow to about $97 billion by 2030.
You've also laid out your expansion plans. I think you're present in 47 cities right now. You're targeting 200 Indian cities by 2030. So as you expand into tier 2, tier 3, what would profitability look like? Will it be dilutive or will it add to your margins?
Well, typically when we look at a tier 2 city, there are a lot of existing investments that we are able to leverage. For example, our technology platform, which is one of our big areas of investment, doesn't need incremental investment when we expand to a new city. We've, from early on, focused on brand building at a national level. So usually when we enter a new city, there's already awareness of the Urban Company brand from users in that city as well as service professionals. In fact, I keep getting emails from cities where we're not present today by users asking us to launch there. We also tend to leverage our training centers in the larger cities across the smaller cities through a hub and spoke model. So it gives us the ability to sweat our training assets further. So the incremental P&L of a new city that we add is usually better compared to an existing city. And contrary to popular wisdom that whenever you enter tier 2 or tier 3 cities, you have to drop prices, we haven't really done that. We've seen pricing power hold up in these cities.
So now let's talk about your second source of income, right? That is native, where you're actually manufacturing water purifiers, for instance. What made you get into this category?
So Rima, we have been in the category of water purifier servicing and filter changes for about 8 to 10 years now. And then about 5-6 years back, we entered into our own private label spare parts, the filters that go in. So there was already a base knowledge and a base consumer, consumer base that was transacting on the platform in this category. These consumers had a deep pain point, which they voiced to us, which is that why does our water purifier need servicing and filter changes every few months? Why do I have to go through the hassle? And And for a while, we felt that this is how the industry is, this is how it operates, what can we do about it? But when this voice from the consumer became, too loud, we decided that let us see if we would want to further vertically integrate and have our own device. It took us we took that call in 2021. It took us about 2 years of product development, R&D, to come up with a state-of-the-art water purifier that is needing no filter changes for up to 2 years. After 2 years, you service it once, and it's again set for another 2 years. It's gotten off to a great start. It did about 116 crores of net revenue in FY25, which was the first full year of operations. In the first quarter, and we've reported that it's done about 60 crores of net revenue. So it's growing at a rapid pace.
But it's loss-making.
It is loss-making right now.
Okay. But what's the scale that you need to flip the margins?
I think, we have already seen operating leverage starting to play out materially in this business. Year on year, the losses have come down at a margin level. And we believe that as we continue to scale it, that operating leverage will play out, and it's a matter of time before this business also turns profitable.
In 2 to 3 years?
Again, I will not be able to focus on the specifics. But, if you look at our past history, newer businesses haven't taken a very long period of time for us.
Okay, 1900 crore IPO opens on the 10th of September and the price band set between 98 to 103 odd rupees. We'll take a break and come back with Manisha Gupta, commodities editor, and what she's tracking in the commodity space. Stay tuned.
Welcome back, and joining us on the show now is Mr. Prithviraj Kothari, who's MD RSBL and also President of India Bullion and Jewellers Association. Mr. Kothari, thank you so much for joining us here at CNBC-TV18. First of all, your sense on where do you think are the gold prices headed from here? We already are trading at a record highs right now. Where would you see gold prices by the time it's end of 2025?
I think in the market right now, in the whole country, on the geopolitical tension is there. Central bank buying is constantly there. People are selling crypto and buying the gold also there. And the de-dollarization. Everything is buying, and the fund increasing, they're buying gold portfolio also. So everyone is buying, no one selling in the market right now. If you see in the scenario hold, every day, if you see in the last week to this week, almost $200 almost increasing in the prices. Still the domestic prices demand, and the same price is the Indian also is the demand. I think maybe price to 3,700, 3,800 in the end of this 2025. And maybe in the second quarter till there is the chances of a $4,000, $4,500. Because everyone is buying as a gold against the dollar. And the geopolitical tension, the sanctioning, everywhere is uncertainty in the market. Right now, in between gold spot market is 3,300 to 3,600 in between. Thereafter, I think slowly they move. Again, any bad news is coming or a tariff, anything else is happening. The market move again to the new direction of 3,700, 750. But in the same in the physical demand also is there in the same. If you see in the India, in ETF also the gold buying huge quantity. Every day we accumulated the gold in the ETF also, as well as the silver. Silver is a huge quantity we accumulated in the ETF also. The buying. Current right now is a buying.
I get your point, Mr. Kothari. As you're saying, there are no sellers in the market right now and strong buying that we are seeing in case of gold and silver as well. So for gold, you've told us that the prices can go to 3,800 by end of this year, even 4,000 in next year. How are you looking at the silver prices? Because silver has outperformed gold in the very near term. We are holding above $40 an ounce. Where do you see silver in the international markets and for the Indian markets by the end of this year?
I think, if you see the silver last 10 years is not performing so well. Now it's a start point. Silver is a $40 is, I think, is the base price. Silver is a huge demand in everywhere. And also the funds also, they create, AMC also they create in portfolio to be a silver. Now, initially they are putting only gold there in the portfolio, but now they are increasing the silver also, including the silver also. So I think silver is some resistant at $43. In terms of Indian rupees is around like 30,000 rupees. And maybe silver, I think in a year, it should be $70. It means I think it's a 2,25,000 easily can be touched if it's our rupees should not be depreciate. So I think silver maybe in a year it's a $70 maybe touch easily $70. I think it's a more than that. So I am more bullish than the gold in the silver.
Oh, wow. $70 an ounce in the international markets for silver. And for the Indian rupees, it could be 2 lakh rupees in 1 year. So clearly, silver seems more bullish there. Mr. Kothari, you told us that investment buying in the Indian markets has been quite firm for gold and silver, even as we are trading at all-time highs. How much of a percentage increase in sense of value or volume? I mean, value we can all look at. But for this festival season, are you looking at increase in volume as well? Or do you think that could suffer?
No, I think we will forget about the volume. Volume, it's as usual is there because a lot of people, the equity market is there, the real estate is also booming. So everywhere there is no liquidity problem in the market. Then monsoon is a good monsoon. If you see the monsoon is almost everywhere in the country is a very good monsoon. So there also the new crops is coming and new money is coming in the market. So I don't think there is any liquidity problem. So I think festival should be as usual, marriages as usual is there. So I think it doesn't affect on the import side. I don't think any effect, but it's almost some volume should become lightweight jewelry as selling more 9 carat also including. So I think the value-wise there should be high, but volume-wise is as usual.
Point taken. Mr. Kothari, one final question. And, going forward from here, as you've talked about much higher numbers from here on, are you anticipating global uncertainty, strong central bank buying, weak US dollar, all of these fundamentals to continue?
I think day after morning, Trump what said, God knows. So its effect in the market. Everyone is a panic. No, every country is a panic, not in the everyone. So I don't think maybe something this should be positive happen, but I don't think till the 3 to 6 months this happen this like this. Ukraine, Russia, Israel, Hamas, everywhere is a tension is there, no? Tariff on India also. So it's all affected in the market, no? We can't say anything about that.
Absolutely, Mr. Kothari. Still there's a lot of uncertainty, but surely, Mr. Kothari as well as Manisha, thank you so much for joining us. And that bullish commentary coming in on silver, that's expected to continue to shine, right? $70 per ounce in the next 1 year. 2 lakh rupees in the 1 year and rupee term in India.
Yeah, from here on, but yes, who knows?
It's like, who knows? But surely silver is not going to lose its sheen. That's the word coming in from Mr. Kothari. But on that note, we're going to slip into a very short break. Remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime records global shifts and their impacts on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Halftime Report on CNBC TV18. Nifty, as of now, has given up some of those gains that we saw coming in the second half of 12:30. Around that time, we saw those gains. Now has come back to 24,600 levels, exactly where we started the show with. So as of now, Nifty is managing to hold on to gains of odd 30 points in trade. But the broader end of the market, that's where we're seeing some bit of the gain coming in, right, as of today. What did well in the last 1 hour? NMDC Steel, that picked up some bit of steam, 2% uptick in the just last 1 hour. Netweb Technologies, that also saw a bit of a further spike up in the last 1 hour. And Coal India, among some of the names that have seen a pickup. While on the flip side, in the last 1 hour, we have seen HPL Power lose some bit of a steam, so keep an eye out on that, as well as Godavari Power has also lost some bit of a steam from the point of, in terms of a further fall coming in for them. But with that, we're going to wind down this edition of Halftime Report on CNBC TV 18. Thank you so much for tuning in. Up next, your Business Lunch.